I hope I'm finding you well this Thursday morning. So we are live every Thursday morning at 10 o'clock. We are live on YouTube on this channel, and I'm glad that you could join me. I am just going to give a brief introduction before we begin, as I'm waiting for more people to come through and join us. So, my name is Carol. I am a tax practitioner. I am a professional accountant and also a corporate governance specialist. And I'm coming to you live from Johannesburg, South Africa. So, on this channel, we discuss mostly tax matters. We also discuss accounting matters. We discuss issues of compliance. We look at how to run your business, how to make a profit. And I'm a business coach. So, please do go back on our channel, have a look at some of our previous videos, and also like this channel, subscribe, be a part of this community so you can get notifications. We come online every Thursday, 10 a.m. on the dot for a 30-minute session. Hi, Kimira. And we are also on TikTok, but please find us on YouTube and please do support. For those of you who are just joining, I see there's a second person. I'm just waiting for the numbers to go up a little bit, and then we'll start our topics for today. I hope you've had a good week. It's been a cold week, and there's been a cold front, but I believe it's starting to warm up now. Still dressed very warmly. And from a business point of view, it's been hopefully a good week for you. This is a very crucial month. August is a very hectic month, and I hope we are all ready for the month and what lies ahead. We are also right at approaching the last quarter of the calendar year, not the tax year, but the calendar year, because as we know, December, everything shuts down. So hopefully you will have all your ducks in a row by then. Okay, I see we have a few more people. I think we can begin. Welcome to those of you who are just joining. I will repeat the introduction a little bit later. I think most of you are regulars and you have been on this channel before. I also see a few new people that are joining us. We are a tax and accounting firm. We discuss tax and accounting issues. Please do join us, look through our videos, look through our shorts, and get informed. Okay, I'm ready to begin. So today, I want to welcome you all. We want to talk about tax matters, accounting matters, things that affect you and things that affect me. The first thing is, remember, I always discuss personal tax issues, I discuss individual issues, and then I move on to corporate issues. I'm going to start on the individual basis. So a lot of you ask me the kind of questions where they say, how do I save on my tax? How do I make sure that I don't pay any more tax than I need to? Very important question. Now, here in South Africa, our revenue authority is called SARS. They are the authority that collects revenue from individuals. And as you know, if you are employed full-time, the pay as you earn is deducted at source. So you have no say in the matter. It is automatically deducted by your employer and it is paid over to SARS. For those of you who are self-employed, yes, you do have time in which you can submit your return and declare your income. So it's a little bit different. But in all instances, there are ways in which we can all save on tax. Monthly tax that we are paying. And I think we have touched on some of those areas in the past. And for today, I'm just going to give a rundown and say to you, here are the areas that where you can save. I'm not going to go into technical detail. I will do another video where I will give figures, facts, and percentages. For now, I'm just giving out information, right? So the first thing you can do to save yourself some tax, or at least to prepare yourself, is to open a tax-free savings account. Now, a tax-free savings account will save you in all sorts of ways. But remember, there is a cap, there is a limit to which you can benefit. As the name goes, it is tax-free. So when you save, with your bank and you open that kind of account, you will not be taxed in any way. So comparing that to a normal investment where you put money aside, say for instance, you're putting aside 1,000, 2,000, 3,000 every month, depending on what you can afford. If you are just saving money and putting it aside in a normal investment account or a normal savings account somewhere, you must know one thing. You will be taxed by SARS when your interest increases to the point where it now goes above the minimum zone. So there is a minimum amount of interest that SARS will not tax. But once you exceed that limit, that cap, you will now begin to be taxed not on the savings, but on the interest that you would have earned. So here's what I'm saying. Interest that you earn on your savings will be taxed if it's a normal saving. But if it's a tax-free saving, then at least you will not be taxed, but only up to a certain extent. Also remember that interest will not automatically be taxed if it's a small amount of interest. It's only once it starts hitting, 20 something thousand, then you will be taxed on that interest. So that's one way to save. Open a tax-free savings account. But again, there's a cap. Second way to save, we've already talked about medical aid. We've already talked about retirement annuity. The fact that those credits will reduce the tax that is due to SARS. So you are saving. You are either saving monthly or you are saving by getting the refund right at the end. I need to address another issue. I had a situation this week with a client who is employed full-time, so she gets her deductions and she is paying over her taxes, her employer is paying. When we were now doing a calculation for the tax return submission, she was in a refundable position because she has medical aid and retirement annuity. However, because she has a property in her name, rental property where she's charging tenants rent, you have to include that, remember. And that rental income, of course, you can deduct only expenses that are directly linked to that rental income. In other words, you can deduct rates, you can deduct levies, insurance on the property, interest on the bond, not the entire repayment of the bond, just the interest. So just those expenses related to the property. When we did that, it turned out for the property alone, she was actually making a profit. The rent she was charging her tenants was high enough to cover the expenses that SARS allows, and she still had a surplus. So in the eyes of SARS, she's making a profit on the rental property, and that means she is now subject to tax on the rental property. So I said to her, regardless of the fact that she's got other personal expenses that she would like to bring in, she cannot. The tax return will need to simply show the IRP5 from the employer and then the rental income plus the rental expenses. And unfortunately, once we include that, it now brought her into a position where her refund was now flipped and she was now owing SARS. So she was no longer due for a refund because of the rental profit. Unfortunately, it is what it is, and that's what it is. If you then say to me, no, but I'm also paying rent where I live, can I not introduce that to reduce my profit on the property? Unfortunately, no, because you are now talking about your place of residence, call it your principal place of residence. You're talking about your daily living expenses, and SARS has nothing to do with those. They are only interested in the business, they're calling it a business, that you are conducting of renting out a property. The next little thing I want to talk about tax-wise, something called capital gains tax. CGT, very complex beast. But I must tell you, if you right now buy a property, whether in your personal name or in the name of the company, and then you decide to sell it, you must know that you need to submit a capital gains calculation to SARS. In other words, you need to prove to SARS that you did not make a profit in the sale of that property. Let me give a brief example. If I buy a property today and it costs me 2 million, that property, I can then say, well, maybe I've done a few repairs. And if I do repairs on that property, get an invoice from the handyman. It must have my name as the owner of the property. It must have the details of what repairs were done, the cost, the date. Must be a proper invoice. So now you have to force your painters and your handyman to do invoices. Okay. So let's keep these figures in mind. I've paid 2 million for my property. I have done renovations for, let's say, 300,000. So far, I've spent 2.3 million on the property. Then I decide a few years later to sell that property, and maybe I'm selling it for 3 million. So the difference between what I'm selling it for, which is 3 million, and the 2.3 million, because you add together the cost, the base cost of what I bought the property plus what I repaired, if I can prove it. Now, the difference between the 3 million I'm selling and the 2.3 million that I bought the property for is 700,000. That is the capital gains. Now, ordinarily, that should be subject to tax, but there are certain exceptions. You now are allowed, if it's your principal place of residence, the place where you live. In other words, you're not just buying and selling and flipping properties as a living. If you are living in that residence and you sell it, you do get what we call an exclusion benefit. In other words, they won't necessarily tax you on that gain, that profit that you made of 700,000. They will only start taxing you once it increases beyond a certain amount. So what am I saying? I'm saying you do not need to worry necessarily if you're selling your principal place of residence, because the chances are your exclusion might just cover your profit. Unless if you have really sold a property for an astronomical amount without doing any repairs whatsoever, maybe the value of the property just went up for whatever reason, or you got a sucker to buy that property for much more than you bought it for, then that means your gain is so huge that it even eats into the exclusion that SARS is allowing you, and you will now have to pay tax. It's called capital gains. Now, this capital gains is included in your personal tax return. When you submit your personal tax return, you include the details of the property. You need to know the year that you bought it, the year you sold it, the year you did the repairs, and you have to submit your own capital gains calculation and enter on the tax return. That will then enable SARS to tell you whether you owe them or not. Now, you cannot get a refund, of course, on your capital gains, but you will just be owing them nothing if there's no actual benefit to the sale of the asset. So those are the things on the personal tax side that I wanted to discuss with you. Now we're moving on to company issues and corporate issues. Many of you are already running businesses. Some of you are working for people that are running businesses. Some of you are just accountants, bookkeepers that will find some of these topics interesting. So today, on the company side or on the corporate side, I also want to tell you that for capital gains applies exactly the same. If it's a company or, for instance, a trust that is doing that, it applies, and it's exactly the same. So I mentioned a trust for a specific reason. Today's topic on the company is going to be interlaced with a little bit of estate planning, a little bit of trust. So remember, I'm not going to go too deep, not too technical, because I'm dealing with different people on this platform. But your topic today is to do with how to protect your assets and how to run your company in conjunction with perhaps a trust or even a property. Now, a lot of people buy properties in their personal name. That has its benefits, but it's even better to put a property in a company or in a trust. Why? Because should anything ever happen to you as an individual, for instance, if you're suddenly indebted to the point where the banks or whoever it is wants to liquidate and take assets, if your property is in a company or in a trust, they can't touch it. The same would happen if you die. If you die and the property is in your personal name, then whoever is to benefit, for instance, your children, will have a very hard time accessing that asset and having it liquidated. The estate needs to be wound up. It's in the hands of SARS. There's taxes to be paid, lawyers to be paid, a whole lot. But if the property is in a company or in a trust, you avoid all of that and the time delays. Because remember, the trust or the property can continue. You just may need to change the director if someone has died, or the trustee if someone has died. So it is better to put your properties in a company or in a trust. Now, there are certain instances where one would need at least one property in their personal name. Maybe you'll need it for visa applications, for instance, or just for your own personal standing. You just need to know that, okay, at least I have one property in my name, though it's not necessarily the safest thing to do. So what am I saying here? I'm saying there are complex things that can be done within companies and trusts, within individuals and companies, within individuals and trusts. For instance, if today you register a family trust, for instance, and now a trust is registered with the Master of the High Court, by the way. It's not done the same way we register companies. It's not with the CIPC, it's with the Master of the High Court. It has trustees. Trustees are the equivalent of directors, okay? They are handling the trust. It will also have beneficiaries. Beneficiaries are exactly as it sounds, the people who will benefit from the trust. Now, what you can do within your trust, you can either decide to say that your company can be a beneficiary, not just individuals, but the company itself can be a beneficiary of the trust. That's how one way in which you can link your trust with your company. So your company can be a beneficiary. Or the other way around, you can actually say that your trust can hold shares in the company. So your trust now becomes a shareholder, either part shareholder or full shareholder of the company. So those are two different ways in which you can link the two entities. That would then make it a more professional setup. So now you can even have a holding company. Then you can have subsidiary companies underneath. And then within that structure, you can still have your trust. Have I got too complicated today? Not really. It's simple. A holding company is more the parent company that perhaps may or may not trade, but it may be the parent company that gave birth or that was there first before all these other subsidiary companies existed. All these companies would have to be registered, of course, with the Register of Companies, and you would simply, in your own company portfolio, just know to say this is the structure. Many people, when they're applying, they need to submit things like an organogram, they need to submit company structures, and that's why I'm addressing it here, because they don't think about it. Remember, so your organogram is simple. It's simply telling whoever you are dealing with who is employed in the company, who is the top person, and who reports to them. And after that, who else reports to that middle person. So you may have a CEO, an MD, or directors at the top. Then you may have managers or supervisors, and then reporting to the supervisors, you may have your maybe clerks or lower level employees. That would constitute an organogram. You also might have an organogram for a trust, where you'd need to show who's the founder of the trust, who are the beneficiaries, and who are the trustees of the trust. So all these organograms are for different purposes, but they are often required. Another thing you may be required to produce is what we call a special resolution. If you are opening a bank account, let's say you register a company, you now need to open a bank account. You may need to do a special resolution. It's very simple. Many people struggle with that. You are simply going to state there that it is hereby resolved that Mr. So-and-so, ID number so-and-so, is authorized to act on behalf of the company. Simple. Very simple. You may need to also talk about signing powers, to say who has the signing mandate, whether it's two directors and both of them need to sign, or only one signs. However you have it in your organization, that can also be included. So those are the other simple things. Often if a company wants to rent a property, they also may be asked to do a special resolution. Now on that resolution, all you'll be saying is, it is hereby resolved that Mr. So-and-so will act on behalf of the company in terms of signing all documents. So they just want some particular person to be able to deal with, because they're dealing with a company, but they don't know who within the company has the authority to do all these things. Having said that, I'm moving to another topic now. When you are exporting goods or exporting services, you will need what we call an export license. Now, an export license is applied for at SARS and it's applied for online. It's one of those things that in the past you had to walk into a SARS branch, but not just any branch. You had to go to the customs branch in Joburg. You had to go all the way out to Alberton to actually apply. Now you cannot walk into a branch and apply. They will refer you to e-filing. So if you are exporting goods, in addition to everything else you might have, you will need an export license. So you'll need to actually get someone registered to apply for an export license for you. It's the same thing if you're importing goods. You also need an import license. Now, an export and an export license are separate. They're not the same. Of course, your actual code, your export code, is the same, but the license itself is different. You must know that if you're importing certain specific goods, for instance, agricultural goods, in addition to the import license, you may need an additional license from the Department of Agriculture, for instance. If it's chemicals as well, you need to clear it with your clearing agent and know that you have acquired the necessary additional licenses, because certain things are restricted and they need an additional license. So some of the other questions I often get is people say to me, I'm operating, for instance, trucks, and the customs have said I need a remover in bond. Now, this is something very new that was not always there. If you are crossing a border as a transporter, for instance, you're taking goods across, not necessarily people, but some are bus operators. You also need the remover in bond license. That is a license that entitles you to move between borders without having to necessarily pay duty. It's a new thing, but it is an additional license that you need to apply for as well. That is a license that gets renewed every year, and it's usually between December and March, it must be renewed. Another license on the customs side, let me just mention them all, is if you are a clearing agent and you're clearing goods for people, you need an additional license as well to be able to do this. So all of these are related to customs. And today I wanted to talk to you about the customs section of SARS. And it's important because many of your clients and some of you, your employers, are or may think of doing imports or doing exports. Some people just importing, they may just decide to import a machine from China, for instance, and they're not necessarily importing as a line of work, but they will require an import license. You cannot just wake up one morning and import something without a license, okay? And you can't use the license of your clearing agent, you need your own license. So it's not like a VAT registration where you had to submit a return all the time. No, it's just a once-off application and the license remains there and you just use it every time you are importing. Now, one other thing I need to tell you, for those of you who are importing, you need what we call an APN number. On the SARS website, on e-filing, within the customs RLA system, you can apply for an APN number. This is something that the bank will need. As long as you are importing something and the value, usually it's if the value exceeds 50,000 US dollars, then you need an APN number. You can't access funds through your banker if you don't have an APN number. So every time you do a new import, you need to apply for an APN number, and it's a SARS thing and it's done on e-filing. Now, the APN number then gets sent to the bank so that the bank knows that you've actually done it, and then they can allow you to import. Another thing that you also might want to know about, besides the APN number, if you're exporting, for instance, you need to make sure that all your documents are stamped, custom stamped. They must be proof of export, proof that they left the country. If it's goods, but if it's services, then that's a bit tricky because you're obviously providing a service, let's say in Algeria, for instance, or in Egypt. Maybe you are providing training over there and you need to prove to SARS that it was not a local sale. Then instead of producing a custom stamped document, you would simply produce a contract to show that you have a contract with so-and-so who's based in Liberia or, wherever, Kenya, and you provided them with a service. Please make sure with all of your dealings that you have contracts. We, in our line of work, we do engagement letters. But for most businesses, it's actually a contract and it must be signed. Anything that you engage in must be signed because it's not an official document if it's not signed. So you, as the author of the document, must sign, and the person you are entering into a contract with must also sign. Jumping to another topic, I'm just making sure I cover everybody today. If you register a company and, for instance, there's more than one director, here is what I recommend. You need to have what we call a shareholders agreement. Some people call it a shareholding agreement, but it's actually a shareholders agreement. Why? Because you need to stipulate and clearly set the parameters of how you're going to trade. I'll give you an example. If you have two men that come together and they register a company, they're both directors, maybe they have equal ownership, equal shareholding, and the company is trading, then calamity hits, one of them passes on. If there's no shareholders agreement, then it's not clear what happens to the business at that point. Does the wife of the deceased come and demand that she now wants to take her husband's place and run? Because it has happened in practice, in case law. Those are some of the reasons why we then advise people to say, have a shareholders agreement. It'll protect you. It'll make sure that in the event of anything happening, you have already outlined the processes. Whether you now say we deregister the company or the company continues to trade, and because this one has died, we simply remove him from the register of directors, or whether the family benefits. The other thing that happens is, as I said, it protects both directors. We now need to know, okay, within the two directors, if I'm one of them, am I allowed to go out and get business in my personal capacity, which should be coming to the company? Those are some of the things that need to be addressed in the shareholders agreement. We are in business together. We are shareholders. We are building something, but none of us should then be wanting to benefit and, to the detriment of the company. So a shareholders agreement will deal with the rules of engagement, how we should be trading. Should we be sharing profits 50-50? Should we be doing dividends, for instance? Should we be looking at the financials so that we ensure that no one director is taking advantage of the other, especially where there's even more than two directors? You need to have a shareholders agreement because you cannot always be, have your eye on the ball all the time. It's also very important to make sure that your signing mandates are known, because then we need to know whether, funds can be paid out at any point to any level without the authorization of everyone, or whether two people need to authorize. So there's so many things that need to be addressed, and only the shareholders agreement can do that. Of course, you'd have your share certificates, which tell us who's holding how many shares. You also have your share register, which gives us the history of who held shares when the company was first registered. Then perhaps some shares were transferred, or someone resigned, or some shares were distributed differently. The share register will give us a history of what happened to the shareholding, whereas the share certificates just tells us today who is holding how many shares. In a nutshell, you need both. In a nutshell, you need your secretarial information to be intact. Listen, it's been great chatting to you today. I thought I'm just going to do tidbits, share with you different areas, different things. Hopefully, one or two of those apply to you and they helped you. But thank you so much for being a part of today's broadcast. Remember, every Thursday, 10 o'clock, we are online, and I hope we can give you information that can help you. Please do share this video with someone. Please subscribe if you haven't subscribed and be a part of our community. Have a good one. Enjoy the rest of your week and keep warm.